So as you remember that in the previous lecture, previous week, we already started topic 5. And in this topic 5, we normally focus on the various types of source of finance that company has to choose raise funds. So this source of finance divided into 2 different parts, so which involve internal source of finance and external source of finance, right? In internal source of finance, we studied 3 different types of source of finance, which involve selling assets, selling product and services, and retain earning. And another name of retain earning is a internal equity. And then we discuss about the external source of finance. External source of finance is a combination of 3 different types of source of finance, involve short-term, long-term, and others. Others involve merger and acquisition. So we already finished internal source of finance, all right? And we also started external source of finance in our previous class. So let's continue with external short-term source of finance, right? So short-term, so that is external, right? So in this short-term external source of finance, I guess we finish 3 or 4 different types of source of finance, right? So in the previous session, we finished about short-term bank loan, right? Second source of finance that we study in last lecture was hire purchase, right? And the third source of finance that we have studied was trade credit, right? Okay, so we finished trade credit as well. Now let's move on to the next source of finance or short-term external source of finance is building society. Building society. So all these 3 we already finished. Now let's move on to next which is building society. Building society. Now, what is the meaning of building society? Building society is, again, it's a source of finance, and this source of finance is useful for those type of people who are unable to borrow money from bank. The reason behind is, if you want to borrow money from bank require certain conditions if you want to borrow money from banks. So first of all, you must have a reliable assets that you can mortgage to bank, so bank can lend you money. Besides that, bank requires some kinds of regular cash flows in your bank account. So it means you must have a regular income, so you will be able to return money back to bank on time. But sometime, and third requirement is that bank not lend you very small amount of money. So if the people require small amount of money and their assets market value may not be reliably estimated, so in this case, we have another options that's called building society. Building society has another name. We also call it pawn shop. Now, what does it mean, pawn shop? In Vietnamese, we call it, I guess we call it kam do or something. I don't know how to write, but in Vietnamese they call kam do. Now, what happened in this? You mortgage your small assets, any kinds of small assets. It could be your mobile phones, it could be your laptop, it could be your motorbike, it could be your car. You mortgage, and then the shop gonna lend you money with some conditions to return money back to you in that time frame. If you return money back to you if you return money back to that shop with interest, that's fine. They will return your assets. Otherwise, they will take control on your assets and they sell to recover money. That's normally banks do. All right. So that is the meaning of this building society. But there is a problem with this building society. The problem of this building society is that maybe or sometime this building society going to charge very high rate of interest, extremely high, sometimes 50% or 100%. I have seen some of people, they have been paying that 100% interest for short period if they borrow money from these kinds of building society. That's the meaning of building society. All right, so you can borrow money without any certain conditions, right? Not specific condition, but again, these kind of building societies are less likely to be controlled or supervised by the governments. Maybe, but not all kinds of. In comparison with banks, these are less controlled. All right. So these are the building societies. So you can also call it pawn shops or exactly like this, right? So is that okay, building society? Did you understand? Student building society, is that okay? So let's move on to next. Now, next source of finance is factoring accounts receivable. Factoring accounts. Did we finish factoring account receivable? I don't exactly remember. How about factory account receivable? We finished, right? Can you please confirm? You did not understand factoring account receivable? Did you understand factoring account receivable, right? Can we move on to next, or do you want me to explain again? Okay, so I'll explain you again. Factoring account receivable. Okay, so now what is the meaning of factoring account receivable? So in this factoring account receivable, we have three parties. In these three parties, we have company, we have accounts receivable, and we have bank. Do you know account receivable? Please tell me, do you know account receivable? Okay. So now, for example, account receivable will take 6 months to return money back to you because they purchase material from you. Now they have to return money to you, right? So they will sign a contract with you. So they will sign contract with you to return money in 6 months, right? So for example, the amount is, let's say, $5,000, right? So now, for example, already 4 months passed, right? Already 4 months passed, right? Now you contact this account receivable to return 5,000 back. And of course, this account receivable will say no, because it's 4 months past, but still 2 months are left to complete the contract. So means they ask you to wait 2 months more, but you really need money now. So let's say you need $4,000 now. You need 4,000 now to invest in another project, but you have to wait 2 more months. But if you wait 2 more months, you will lose this project to invest $4,000. You will lose investment opportunity. So that's why you will go to bank to borrow money from bank. When you will go to bank, you will mortgage your account receivable, which value approximately $5,000. All right. So bank will lend you money on this $5,000 mortgage. So let's say, of course, bank will not lend you $5,000. For example, bank is lending you $4,500. All right, for 2 months. Why 2 months? Because the life is 2 months. Only 2 months left to receive money from account receivable. So bank is lending you money for 2 months. So if before 2 months, if company return this 4,500 with interest to bank, then okay, then bank will return your account receivable back to you, and then when time will come, you will receive this $5,000 back from your account receivable. That's supposed to happen. But if you do not return this $4,500 with interest to bank, then bank will collect this $5,000 from account receivable because you mortgage your account receivable. So bank has a right to receive this $5,000 from account receivable. So bank is lending 4,500 and bank is receiving 5,000. So bank is making $500 from here. This is called factoring accounts receivable. Is that okay? Understand? Now let's move on to next external short-term source of finance. Now next one is bank overdraft. Bank overdraft. Another name of bank overdraft, we also call it commercial credit card. So we call it bank overdraft or commercial credit cards. Now, what is that? It's exactly like as your credit cards. Now, what happened in credit cards? In credit cards, normally banks provides you a credit cards. So let's say your credit cards, commercial credit cards. So in these credit cards, bank is giving you limits to withdraw money. So for example, bank is giving you $10,000 limit. So you can withdraw, you can use this credit card for $10,000 purchases. So for example, you use these credit cards and you spend, let's say, $7,000. Right? Now bank is giving you, it depends upon banks to bank. Some bank give 2 months, some bank give 3 months. For example, banks are giving you 3 months, 90 days to return this $7,000 back to bank. If you return this $7,000 to bank within 90 days, that's fine. Then bank will not charge any interest from you. But if you do not return this money back to bank within 90 days, then bank gonna charge very high rate of interest. Maybe 20%, maybe 25%, or maybe 30%. It depends, all right? So as you can see, the time period is 90 days, and nobody likes to return money after these 90 days, because they know that if they return money after these 90 days, they have to pay high interest. So as a result, this is a short-term, external, short-term source of finance, right? And this source of finance is unsecured. Remember, this is unsecured. This is unsecured. Unsecured means when banks give you credit cards, bank do not mortgage any assets from you. So means bank is not taking any kinds of assets from you. That's why this bank overdraft is unsecured. No security, no mortgage. But this short-term bank loan are secured loan. So we call it secured borrowing or secured loan. We call it unsecured loan. All right, because you are not mortgage any kinds of assets. So normally bank issue these credit cards to some kinds of loyal customers. The bank do not give credit cards to all kinds of customers. So, and the credit cards limits are different. Some have maybe 10,000, some 20,000, some 50,000. So it depends upon people to people. So it depends upon how loyal you are to the bank. How long have you been connected with bank? All right. So these are the external short-term source of finance, right? Is that okay? Understand? Yes or no? Can we move on to the next, to the last external short-term source of finance? Let's move on to next. Next, so next is a lease. Lease. There are two types of lease: operating lease and finance lease. Operating lease are your source of short-term source of finance, and finance lease is your long-term source of finance. All right. So we start with short-term source of finance, obviously, because we are studying short-term source of finance. So we have a operating lease. So before we understand operating lease, we have to understand lease. Now, what is the meaning of lease? In simple language, lease means rent. When you rent any kinds of assets, that's called lease the assets. Now, so we have to understand what is the meaning of lease. In lease, we have risk and rewards. Risk means any kinds of cost or loss. If you have assets, if assets have any kinds of cost, you repair the assets, you maintain the assets, or if assets broke down and you fix the assets, that's called the risk related to assets, right? Reward means you have any kinds of income, any kinds of profit. You have any profit by using that asset, or you have any income by using that assets. This is called the reward. All right. Now, what is the meaning of lease? In order to understand operating lease and finance lease, that is long term, we have to understand risk and reward. But what is the meaning of risk? Lease. Lease means, lease is a contract. It's a contract in which two parties agreed to transfer the assets without transferring the ownership. All right. Two parties. Which two parties? So we have two types of parties. One, we are lessor and lessee. Lessor and lessee, two parties. Lessor means the owner of the assets, right? And lessee means the customer who wanna use the assets. So transfer the assets. Transfer the asset means I am giving you assets, so you can use the assets. You have to pay me a rent, right? So you have to pay me a rent, but without transferring the ownership. Only transfer the right, not transfer the ownership. Ownership means, so the owner of the asset, so for example, this is a machine, right? So let's say this is a machine. So lessor transferring this machine to lessee. So this is called transfer the assets, right? But lessee without transferring ownership. So lessee do not become an owner. Lessee simply use the assets, but lessee doesn't have right to sell the assets. Exactly like us, probably you and me. Sometimes we rent a house or we rent a room, right? So if you're renting a house or renting a room, then we receive the house, we receive the room. So transfer from owner to customer, but no transfer ownership. So it means we receive a house to live only. We don't, and of course we have to pay rent, and we do not have right to sell it. We cannot sell these assets. That's called ownership. Only the owner of the house have a right to sell the assets. If we are renting a room, renting a house, we don't have a right to sell. All right, so that's the meaning of lease. That's the meaning of lease. Now, what is operating lease? So here is operating lease. Operating lease means risk and reward. Risk and reward transfer from lessor to lessee. Risk and reward transfer. Sorry, I misunderstood. Risk and reward do not transfer. Risk and reward do not transfer. It means risk belongs to owner, is not transfer. Reward also belongs to owner, do not transfer. That's called operating lease. Now let me give you example of operating lease. Example of operating lease is, for example, when we travel, we stay in hotel, right? We are staying in a hotel. So you are staying in a hotel. Who we are a customer, we are lessee. We sign a contract short term to stay in a hotel for 2 days, 3 days, or maybe 1 week or 10 days, right? And if in this hotel, in your hotel room, you have electronics item, for example, you have a TV, you have aircon, you have refrigerators and fan and so on. If anything broke down because of technical reasons, if it has any technical problems and things break down, who will fix it? Customer who is renting a room or the owner of the hotel? Of course, the owner of the hotel. That's the meaning of risk do not transfer from owner to customer. No, risk remain with the owner of the assets. If the assets, if the room, if the hotel has any problem, who will fix? Owner. That's the meaning of risk remain with the owner. Reward. Reward means, for example, do you have any rights to invite some more people to stay in your hotel? So you will share the room. You have a right to share the rooms without taking permission from the owner? No. For example, you're renting a room with one bed, but you invite 5 or 6 different people, they can stay in your room. That sounds really weird, but you're inviting 4 or 5 different people so they can stay with you and we can share the rent. Can we do that? Of course not, because in hotel rooms, one bedroom, 1 or 2 people can stay maximum. I don't know, it depends upon hotels to hotel. But of course, they never allowed to stay 5 or 6 different people. So you don't have any benefits you don't have any right to take benefits from the assets that you are renting. Only owner has a right. If owner wants to put 2 beds in that rooms and rent that room for 2 people, owner can do that. So that is the meaning of operating lease. So what is the meaning of operating lease? Operating lease means risk and rewards. Risk means any kinds of cost. Reward means benefits. Risk and rewards do not transfer from lessor to lessee. All right. Do not transfer risk and reward from lessor to lessee. All the risk will be bear by the lessor, the owner, and all the cost, sorry, all the benefits also received by the owner. That's called operating lease. All right. Now, finance lease. So remember, operating lease is a short-term source of finance. All right. And finance lease is a long-term source of finance. All right. Finance lease is a long-term and operating lease, it's a short-term. So when we study about long-term, we will not discuss this finance lease again because I am explaining you right now. Right. Now, finance lease. Finance lease is opposite of operating lease. So it means under finance lease, risk and rewards transfer from lessor to lessee. Right? Lessor to lessee. Risk means, again, any kinds of cost related to assets, that cost will be bear by the lessee. And any kinds of benefits of the assets, that benefits will be bear by lessee as well. So let me give you example. In operating lease, I give example of hotels, all right? Staying in a hotel. Now the example of finance lease is a renting a shop or space in a mall, right? You're renting a shop or you're renting any kinds of space or the corner in a mall. So the owner of the mall give you that space or shop. Now, they will not give you all the facilities. They give you some basic facilities, maybe air conditions, maybe lights, or maybe power or access to the mall, right? That's basic facilities you're gonna have. Now, it's up to you. Whatever business you wanna open it. You wanna open a tea shop, you wanna open a restaurants, you wanna open a bookstore, you wanna open a clothes shops, you wanna open a shoe shop, you wanna open a toy shops. It's up to you. You can do whatever you like. So that's called the benefits. You can do whatever business you like. The owner will not stop you. As long as you are doing a legal business, that's fine. All right. So it means benefits belongs to lessee, the customer. Cost. Cost means in the mall or in the shop, the shop that you are renting, they most likely to give you very, very empty space. You can fix air conditions by spending your money. Maybe if you need more, you can you wanna make some interior changes in your shop. Depends upon the business that you are going to open. If you're gonna open a shoe shop, you have to make interiors according to the shoe shops. If you wanna open a restaurants, you require different interiors for the restaurants, right? So you can, whatever you wanna change it, you have to spend money on it. So let's say if you fix a air con, if you put a TV or computer, if the TV, computer, or air con break down, who will fix? Of course, you will fix, not the owner of the assets will fix. Will fix. That's called the risk belongs to the lessee. So risk and reward, transfer, benefits, profit, income, you can make it, and the cost, expense related to the assets, transfer under finance lease. An operating lease, not transfer. You cannot change the assets, right? You cannot add something different in that assets under operating lease. Like for example, in hotels, you cannot change whatever you like in the hotel room. You can't change TV, you can't change air con, you can't change the beds, you can't change the refrigerators or fan and so on. You don't have a right to do that. But under finance lease, you can, whatever you can make changes in that assets, you can make it. But again, when the contract is finished, you will return that asset in the same condition that you borrowed as per contract. That is operating and finance lease. So operating lease is a short term and finance lease is a long-term source of finance, right? Is that okay? Understand? Operating lease, finance lease, any question? Student, any question? Operating lease, finance lease. Any question? No question. If no questions, then we can have a break. And after break, we will move on to the long-term source of finance. So short-term source of finance are finished. So we study 7 different types of short-term source of finance. The first one was short-term bank loan. Second one was a hire purchase. Third one was a trade credit. Fourth one was a building society. The fifth one was bank overdraft. Sixth one was factoring account receivable. And the seventh one is the operating lease. So we have a 7 source of finance under short-term external. All right. So now we can have a break. After break, we will continue to the long-term external source of finance. So let's have a break. Now we move on to the long-term external source of finance. So the first long-term external source of finance, you know that we just recently finished, which is finance lease. Which means risk and rewards transfer from lessor to lessee, right? Risk and reward transfer from lessor to lessee. Now, second external long-term source of finance that you also know that, which is bank loan, long-term bank loan. So which means borrow money from bank. Borrow money from bank, that is your long-term external source of finance that you also know that. Right? Another one is bonds, corporate bonds or municipal bonds that you also study in your topic 2, which is financial market. That's also your external long-term source of finance. I don't have to explain these bonds, you know that. And the next are stocks or shares. And you know that we have 2 different types of stocks here. Common shares or common stocks. Right? And preference stock. Preference stocks, right? So all these are external long-term source of finance. So external long-term source of finance are finished. So we study 4 long-term. We study 7 short-term and 4 long-term. Now long-term external source of finance is finished. Now we move on to the last external source of finance, which is others, merger and acquisition. And then after that one, topic 5 will be finished. So let's move on to the last external source of finance. That is others, which is merger and acquisition. That's your external. Right. So let's start with the merger and acquisition. So mainly we focus on equations. That's acquisition. So what is the meaning of merger and acquisition? So normally we focus on the mergers. So acquisition means when one company acquire another company. One company acquire another one. That's called acquisition. Now merger means when one company merge with another company. That's called merger, right? Now this merger, we have types. So we will have a look 3 different types of merger here. So the first merger is a vertical merger. Vertical merger. Second one is horizontal. And the third one is conglomerate. Right? Vertical merger, horizontal merger, and conglomerate. Now, vertical merger. Now, what is the meaning of vertical merger? So as you can see, vertical means, let's say one company merge with another company. This is called vertical merger. So who these companies are? For example, this is a company who produce a product, and this is a supplier who supply material to the company. When this company A with merge with company B, who is a supplier also company, right? When company A when company A merged with company B, this is called a vertical merger, especially when one company going to acquire its supplier. So what are the, we can say that, conditions to explain, or what are the circumstances to explain this kind of vertical mergers? So remember, in this vertical merger, both companies, they have different market. They have a completely different market. Different market means they have a different customers. For example, this company A is about car manufacturer. They manufacture car. And company B, let's say, about steel manufacturing. So steel manufacturing, so steel is a material for this car company. So this company B supply material to company A. All right. So company B has a different suppliers. The supplier who need only steel, and company B has a different customers. The customer who need only steel, and company A has a different customer who only buy cars. So they have a different customers. They have different product or services. Their product and services are also not same. They produce, company B produce steel and company A produce car. So these are the basically the conditions or circumstances or requirements to explain the vertical mergers. They have a different market and they have a different product and service. Next is a horizontal merger. So horizontal merger here, let's say company A and B. So horizontal is like this. This means in this horizontal merger, both companies, they have same market, and they have a maybe nearly same product and services. For example, company A about mobile phones, and company B also about mobile phones. So when company A will merge with company B, they will merge with each other. That's called horizontal merger. So in horizontal merger, these companies, they have a same market and same product and service. All right, so that is the meaning of this horizontal merger. All right, now let's move on to the next, conglomerate. Now, what is conglomerate? Conglomerate means when one company merge with another company, and these companies do not have any relation, direct or indirect. All right, their product may not be same, their market may not be same, and they don't have a same relation. They don't have a service exchange of service between each others. So they are completely different in natures. All right. So let's say company A and company B. For example, company A is a bank. All right. And company B, for example, car manufacturers. When these two companies going to merge together, that's called conglomerate. Bank, which belongs to service sectors, and car, which belongs to manufacturing sector. So they are not direct or indirectly connected with each others. Like as vertical, both may come from the same industry or different industry, but at least they have a relation. They are providing services to each others, like as suppliers providing services to the car manufacturers, steel suppliers. Horizontal, also like this. They do not supplying services and product to each other, but at least they come from the same market and same product and service. So they are competitors, so they have a relations, compete, affect their business. All right. Each company decision may affect the another companies, right? Next is a conglomerate that I just explained to you. They have no relation. Maybe bank decision may not affect this car company, car manufacturers. Maybe, maybe not. So this is the ideas behind the conglomerate. So that's all about your topic 5. So topic 5 is finished. Merger, acquisition, one external source of finance, and another one was a long-term, which is bank loan, bonds, finance lease and stocks, and short term that we already discussed before. Besides that, we also study internal source of finance that we also discussed in the beginning of this class and the last lecture, right? That's all for topic 5. So topic 5, week 13 is finished. So anybody has any question regarding topic 5? Any question? No question. All right. So no question, then we stop here. So I'll see you next week. So next week we will start next topic, topic 6. So we have 2 classes left next week, which is week 14, and week later, week 15. So week 14 and 15 we will spend on topic 6, which is about calculations, investment appraisal calculations. All right. So we stop here. I'll see you next week, Tuesday. Thank you. Bye-bye.